If there's a company that makes $1 million a year in revenue, they have $500,000 a year in expenses, they have $500,000 in profit left, who does this profit go to? It doesn't go to the employees, it doesn't go to the managers, it doesn't go to the CEO, it goes to the owners. Now sometimes the owners will be the employees, sometimes the owners will be the CEO, sometimes it'll be a random person, and you want to be that random person. How can you own the profits? That way you can get paid without having to work. Now maybe this means your company allows you to buy some ownership in your company. If, number one, your company allows for that, and if you believe in your company and you want to invest in that. But that is not available for everybody because some companies don't allow their employees to have ownership in their company. So what do you do then? Well, that's okay. There are many other options. This is where the stock market comes into play. The stock market is a place where you can go out and buy ownership into any publicly traded company. A publicly traded company is a company that trades on the stock market. So that means, let's assume that a company owns 100%, or a founder owns 100% of a company, and now they sell off 50% ownership in a company. That means now people can buy and sell a piece, meaning a share of this ownership in the company. So if you go out and you buy one share of Amazon on the stock market, you become one of the owners of Amazon because you own one share. And when you own one share, one piece of ownership, you're entitled to your portion of the profits. Now the question is, how do you get paid? There are two ways that you can get paid. Number one is Amazon might give you just a cash distribution. It's called a dividend, where they take a piece of this profit and they just write you a check. Now, in practicality, they're not sending out checks anymore. The way it works is you get this money deposited directly into your stock brokerage account. So if you invest in a company that's making profits and they're paying out a dividend, because not every company is profitable and not every company pays out a dividend, but if a company pays out a dividend, you would get a cash flow, you would get a dividend relative to how many shares that you own, how big of a piece of ownership that you own in the company. The more shares that you own, the bigger the dividends that you're going to receive. The second way that you can get paid is if the value of your investment goes up. So let's think about that now. If this company right here makes $500,000 in profit, what is the worth of this company? What is the valuation of this company? Now, it just depends on what you think this company is worth. But the benefit of the stock market is you can exactly see how much a company is worth. It's called a company's market capitalization. So let's just assume, let's put some round numbers on this, that this company is selling for 10 times profits. That means if it made $500,000 in profits and is selling for 10 times profits, this means this company is worth $5 million. Now, if you own 10% of this company, that means you own $500,000 worth of assets. Now, what happens if next year this company grows its profits from $500,000 to $600,000? Well, now, if it's still selling for that 10 times multiple, that means now this company is worth $6 million. And that means now, if you own 10% of this, you now have an investment worth $600,000. So your investment grew from $500,000 to $600,000. This is called appreciation. This is when the value of investment goes up. So if you buy a stock for $100 a share, and then it goes up to $200 a share, this is what's happening. Investors are looking at this and they're saying, it's growing its profits, or we think it's going to grow its profits, and so now we believe that this company is worth more money, and so the value of your company goes up. But ultimately it comes back to the same thing. You're owning a share, you're owning a piece of a company, you're owning a piece of an asset that's either paying you money directly through a dividend, or the value of investment goes up. Now, personally, I like having the cash in my hand because it's a guaranteed payment. I mean, this appreciation isn't guaranteed. We don't know what the value of a company is going to be next year, and the valuation could crash tomorrow if the stock market crashes, because we know stock market crashes happen. It's a part of the economy. But you got to figure out what's right for you. Another way that you can do this outside of investing in the stock market is you can go out and invest in a startup. There are a lot of platforms online that will allow you to invest in startups, early stage companies that are hoping to either get acquired or go public on the stock market. And if you can find a big company or a strong company before everybody else does, before it makes it on the stock market, well, you could see huge returns on your investment. But it's also more risky, because the smaller the company, the more risk that you're also taking on, especially if you don't really understand what the company does. That's why they say 9 out of 10 startups fail in the first 5 years, so it's more risk. It's similar with investing in real estate. The way that real estate investing works is you're going to go out and buy a property. Maybe it's a house, maybe it's a condo, maybe it's an apartment complex, maybe it's an office building, maybe it's a retail building. But you're buying this building, you're buying this property, and then you're going to rent it out to somebody else. And then these rent payments are going to then pay for your expenses. Now your expenses might include your property taxes, your insurance, your maintenance fees, your management fees, because I don't want you to manage it yourself, and then cover the expenses when the property is vacant. Then if you have debt, you got to pay those debt payments as well. And then anything that's left after paying all the expenses, that's again the profit. Now, who does that profit go to? That profit doesn't go to the manager. It doesn't go to the contractor. It goes to the owner of the asset. It goes to the owners if there's multiple owners. It's not if you own the asset, if you own the real estate, you are getting that profit distribution because you own that property. So this is where the game, the money game that every single wealthy person is playing is not how do I grow my salary, it's how do I grow my profits. And the way you grow your profits is by growing your equity, growing your ownership in assets. And there are two ways to do that. You can either buy the asset or you can build the asset, and this is how you buy it. Now I'm going to give you a couple ideas. I'm not telling you what to invest in, I'm just giving you a couple ideas. If you don't want to go out and try to find the best company to invest in, there are also funds that you can consider investing in. These include ETFs, mutual funds, and index funds. A couple examples. Again, I'm not telling you what to invest in. SPY is a very popular one. This is an ETF, meaning it's a fund that gives you exposure to the top 500 companies in the stock market. Now, you're not investing in one company or two companies, you're investing in the biggest 500 companies in the stock market through this, and you don't have to worry about trying to find the top company. Another example that you may want to consider is VTI. This is an ETF created by Vanguard. This is a fund that gives you exposure to the total stock market. Now, we know the stock market goes up and down. We've seen recessions. We've seen about 16 recessions in the last 100 years. We've seen market crashes. We've seen upswings, downswings. But despite all that, we've seen the market rise generally over the long term. So if you just want to invest in the stock market, VTI gives you exposure to the total stock market. Now the key here is when markets go up and markets go down, you keep investing. I call it ABB. Always be buying. That's how you win. You buy when markets go up, you buy when markets go down, you buy when markets are sideways. That way you can allow your wealth to really grow over the long term. We're not talking about 2 months or 2 years, I'm talking about decades. That's where the real wealth is built here. So let's break down where we are. My definition of wealth is not having $1 million in your bank account, is having enough income from your investments that come passively that pay for your expenses. That's what wealth is. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.